What are the most damaging IRS myths or misconceptions that you see real estate investors fall for?
Oh, that's an easy one. The biggest one I see is real estate investors. Sometime the landscape here is real estate income or losses. Real estate losses are passive activity by default. That's the category of that income. Passive activity losses can't offset your other income. So if you have a big W-2 or one of the spouses has a big W-2 or trade or business income from, like, say, being a realtor's business, and then you have losses on your real estate investments, like oftentimes rental houses have losses, or if you have a loss on a rental because you did a big cost segregation study and had a huge deduction, or maybe it's just the first year, so it's a big deduction, a net loss. What I see all the time is people think that loss is going to help them offset their other income, but it doesn't, because they don't understand Section 469 of the code, where these passive activity losses are limited. For most of our clients, they're limited to zero, except they can offset other passive income, which usually don't have a lot of other passive income. You have mostly most people's income, W-2, trader business income, S corp income, all that is active. Ordinary income and the passive activity can't offset that. So they don't understand that. But there are a couple of exceptions. Sometimes you have to sort of structure and do documentation during the year to qualify for these exceptions. But there's two that come up all the time for real estate investors. One is if you have a short-term rental, meaning your average duration of your tenant stay is 7 days or less, then these passive activity losses, what would be passive activity losses, low, and those losses offset. So what I tell people is, if they buy a short-term rental, or if we do a cost seg on a short-term rental for that year, you for sure need to make sure you operate it as a short-term rental and meet the 7 days or less.